So in a recent community post on my channel, I asked you all to give me your financial planning related questions that you can't seem to find good answers to online. I then said that if I could answer those conceptually with the help of the tools available to me, I'll do a video on them. Thank you for all the answers that you gave, because there are some really good topics in there that I'm going to be taking on for you in this upcoming series of videos. The first question that I'm going to look at is one from Chris Haig, I think that's how you pronounce that, where he asked me to demonstrate how trusts work for the purposes of saving inheritance tax. But a similar question was also posed by Paul Evans, so I'll cover all of this in today's video. The first thing I'm going to say though is that what I'm going to take you through is not a recommendation of any sort. Estate planning and IHT, inheritance tax planning, are areas that require detailed advice, and what I'm showing here isn't reflective of the full process I'd follow when planning with a client. It's simply to demonstrate some of the common types of trusts that are available, how they work, and what the indicative taxation impact of certain trust products might be. It's in no way an exhaustive list of the options that are available, but let's jump into Voyant. So we have a client here, Jim, who's 70 and has a net worth of currently £2.5 million, with £500,000 of that in a pension environment. So a taxable estate for IHT purposes of £2 million. Quite a common scenario that I see. In this particular case, he's divorced, he's single, and he does have children. We're assuming that his will leaves everything to his kids. I'll tell you why that's relevant shortly. The assets that would be subject to IHT are shown here, and they are cash in the bank, money held in stocks and general investment accounts, an ISA, and a property worth £850,000. Probably quite a big place for a single chap to be rolling around in, but there we go. If we go to the legacy section here, it shows us a projection of the amount of tax that would be due at the end of the timeline, which we've assumed is age 95. And it gives us a figure of just over £1.1 million. That makes certain assumptions of expenditure, growth on assets, and growth on nil rate bands, which I won't go into because it's not really important. We're just looking to establish the initial projected tax figure, but more importantly, the projected net worth after tax, which is £3.57 million. We'll be focusing on how we can improve that with trusts. We can also look to see what the tax position would be if he died today, not at the end of the timeline, so his immediate liability. And we can see that the current inheritance tax figure his beneficiaries would be liable for is £622,466. No wonder he wants a bit of advice. If we open this up into the detail, it breaks down how that figure has been arrived at. So we can see that his estate is worth £2,037,444, and his inheritance tax nil rate band is £481,278, including his standard nil rate band and his main residence exemption, which is an allowance that's offset against the value of a main residence upon death. So these are the allowances that are taken off the value of his assets before tax is calculated. Now some of you might be thinking, hang on, the standard nil rate band looks correct at 325k, but the main residence exemption should be 175k. Why is it lower? Well, the answer is in the fact that his taxable estate exceeds £2 million. You lose £1 of the exemption for every £2 that your estate exceeds 2 million. Hence why we're left with this slightly reduced figure. I also said earlier that our client here is leaving his home to his kids, which is very important because you only qualify for this exemption at all if you're leaving your main residence to a lineal descendant, i.e. kids or grandkids. This is where gifting money can be helpful for people in this territory, because when the money eventually falls outside of your estate, you can effectively buy back more of your exemption. It's also where debt in your estate can be helpful through the use of things like equity release products, because they can reduce the value of your estate as long as the capital that's released is deployed in certain ways. That's probably something for a future video though. It's certainly an area where the right individual advice is absolutely essential. Anyway, back to the plan, and we can see that after all allowances are deducted, the immediate net worth after tax is just over £1.9 million. We'll be seeing how we can improve that too. So what actually is a trust? Well, to give it its definition, it's an arrangement whereby a person, a trustee, holds property as its nominal owner for the good of one or more beneficiaries. In simple terms, it's an arrangement through which you can give assets away while exercising control over who benefits and when they benefit. The person who creates a trust is called a settlor, and the people responsible for how the trust property is managed and distributed are called trustees. The settlor is generally an automatic trustee. A bare trust or absolute trust is effectively an outright gift to a beneficiary or beneficiaries. If the beneficiary is over 18 or 16 in Scotland, they have a right to all of the capital and the income that arises from that capital at any time. So bare trusts are usually used for children and looked after by trustees until they reach the age of 18 and can take care of the money themselves. If you establish a bare gift trust in favour of somebody already over the age of 18, it's effectively the same as just giving them the money or the asset. A discretionary trust is different because it allows the trustees discretion over how much gets paid out and when, and it may also allow the trustees to alter the beneficiaries and the proportion of the trust that they're entitled to. There are other types of trusts, and I won't go into all of them because what we're focusing on is the difference between how bare trusts and how discretionary trusts are treated for inheritance tax purposes. A settlement into a bare trust or an outright gift is called a potentially exempt transfer, or PET for short. There are no immediate inheritance tax implications to making a PET, and it's still counted as part of your estate for 7 years before it becomes free of inheritance tax. But the amount of tax on the PET starts to reduce down from 40% after 3 years. A settlement into a discretionary trust is called a chargeable lifetime transfer, or CLT. Like a PET, it will fall out of your estate after 7 years. But when you make a CLT, you can be liable for inheritance tax immediately at half of the death rate. So you could pay 20% on a CLT immediately. That's usually only if the gift exceeds your nil rate band of £325,000 though. So let's say you settled £400,000 into a discretionary trust. Tax would be due on the excess £75,000. What you have to be super careful of though is whether you've made any other CLTs within the previous 7 years, because they'll reduce the amount of nil rate band available to you for your next CLT. There'll also be periodic charges every 10 years on any excesses and exit charges when the trust's assets are distributed. I won't go through all of this because it's complex, but suffice it to say, advice is essential. You have to be aware of how the amount of gifting, the timing of gifts, and the types of trusts used all interact from a tax planning perspective. Doing things in slightly the wrong order or at the wrong time can mean that gifts made up to 14 years before your death are sucked into the IHT calculation. The great thing about Voyant though is that it's clever enough to have the tax scenarios built into it, as long as we get all of the inputs right. So let's jump back into it to test out some different trusts. Earlier on we saw that the estimated net worth after tax was £3.57 million. So how can different trusts help to improve that? Well, let's say Jim thought, I'd like to gift some money to my kids, but I don't want to give it all to them now. I want to still retain some control over the money, even though I'm not going to need it myself. He could set up a discretionary trust. So he decides to settle £200,000 into the trust, which is then invested into an investment bond. Investment bonds are the vehicle most commonly used in trust planning because they're non-income producing, so they avoid the penal tax charges on trust income. They're not to be confused with the bonds you'll find in your investment funds though, such as gilts and corporate bonds. They're a different type of thing. Investment bonds in this sense are an account, a wrapper that you can hold funds in, not an asset within a fund. So the £200,000 is invested, he hasn't made any gifts before, and he isn't planning on making any further ones, so we haven't got any CLT charges to be concerned about, and we probably won't have to be worrying about any periodic charges unless the investment grows phenomenally well. So what impact does that have on the projected net worth, assuming he lives until the end of the timeline? Well, it makes quite a big difference and pushes it up from £3.57 million to £3.93 million, which is about a £360,000 improvement, which also includes a saving of around £218,000 over the timeline. The remaining difference comes from the higher projected growth from the investment bond compared to leaving the money on deposit. The interesting thing about the tax saving though is that part of it has been created by buying back some of the main residence exemption. You can see here that it's increased from 61,000 to over 242,000. That's because when the gift falls outside of the estate, Jim's actually got a smaller estate, so there's less money exceeding the threshold at which that exemption starts to reduce. What if he didn't want to give the money away completely though? He wanted to improve the net position of his estate for his beneficiaries, but he didn't want to lose all access to the capital. Well, there are a couple of options here, and one is called a discounted gift trust. DGTs are useful for people who still want an income. They're happy to forego access to the capital, but they still want regular payments, and they basically establish two distinct rights. The settlor's right to pre-agreed regular payments for life, and the beneficiary's right to the trust fund after the settlor's death. The pre-agreed regular withdrawals are added up to arrive at an assumed amount that will be taken out over the settlor's lifetime, and that is then given as an immediate discount. It comes out of the estate straight away, not after 7 years. So let's say there's a £200,000 investment, and it's expected that your lifetime withdrawal will be £100,000. £100,000 immediately comes out of the estate, saving you £40,000 in IHT straight away. The other £100,000 is a PET or a CLT, depending on whether it's an absolute or a discretionary discounted gift trust that you use, and that will come out after 7 years. Again, it's a bit more complex than how I've just laid it out, and these cases have to be underwritten at outset to determine the discount based on a number of factors. Generally speaking though, the younger and healthier you are, the bigger the immediate discount you're going to get. But you have to remember that apart from a defined withdrawal amount, you're losing access to the rest of the capital, and those withdrawals will be eroded by inflation over time. So, in Voyant, we've assumed in this scenario that the client has used a discounted gift trust with the same £200,000 invested into a bond, but they're taking 4%, i.e. £8,000 a year out of it, and still therefore receiving some benefit. We'll also assume that the immediate estate discount is £100,000. We can see that by using this trust, we've increased the gross projected value of Jim's future assets by around £117,000, but decreased the estate value, i.e. the amount that's subject to tax, by £75,000. The main residence exemption is once again improved compared to the base plan, albeit not by as much as with the outright gift, because less money has actually been given away. All of that has led to a £46,000 reduction in tax and a £172,000 improvement in the net legacy position. As well as that though, the immediate net worth position has improved by over £50,000 because there's that instant inheritance tax saving due to the DGT discount. So as you can see, it is still possible to improve your tax position with trusts without losing access to the capital. Finally, another option that exists if you want to retain even more flexibility regarding access to capital is a loan trust. When you create a loan trust, there's no transfer of value for IHT purposes. You're loaning capital to the trustees rather than gifting it, which means there's no PET or CLT. The loan that you make is interest-free and repayable on demand. You can take back any amount of the original capital at any time, but any growth on the capital invested belongs to the beneficiaries. So this makes a loan trust good for people who want to do some IHT planning, but they don't want to lose access to their capital because they don't know whether they'll need it. They just want to prevent growth from making their inheritance tax position worse. What a lot of people do is use the 5% tax-deferred annual withdrawal allowance of a bond to withdraw money every year like an income without giving rise to an immediate tax charge. So what this does is gradually reduce the size of the loan owed to the estate, while the value of the bond is ideally growing by an amount equal to or greater than what's being withdrawn. And that all sits outside of the estate, meaning the taxable value of the estate reduces year on year. So for example, you've loaned £200,000 to a loan trust, which is invested in a bond. You request a repayment of 4% of your capital every year to help cover your expenditure. And let's say the bond grows by 4% every year, net of all costs. After 25 years, you've taken all of your capital back and spent it, but there's still £200,000 there for the beneficiaries, which is all outside of your estate. If you don't need to withdraw, you can waive or gift your right to all or part of the loan, which is then a PET or a CLT, but any growth is already outside of your estate. So if Jim was to utilise a loan trust by loaning the same £200,000 and then withdrawing the same £8,000 a year as with the DGT, it again creates a marked improvement on the projected net worth position of the estate versus the base plan, around a £165,000 improvement with a £41,000 tax saving. The position would be almost identical to the discounted gift trust at the end of the timeline, but more flexibility is retained with the loan trust. The downside is that you wouldn't get that immediate tax saving and boost to net worth position that the DGT provides. So it always comes down to your own position as an individual and what your specific goals are. Remember guys, you will be able to get access to this fantastic tool yourself soon through my Voyant Masterclass, which I'm launching very soon. Make sure you sign up to my mailing list in the description below to stay updated. Now do please let me know if you have any questions regarding these trusts and I'll try to answer them. Let me know if what you've learned has been helpful, and also keep giving me your suggestions of videos because I do like to create things that are going to be useful. My next video is going to be homing in on some income tax planning with pensions that very few people understand and take advantage of, so tune in for that. That's all guys, I'll see you next time.